Hey guys, it's your boy Josh Brown, and I am here with Callie Cox. For those who don't know, Callie is the chief strategist at Ritholtz Wealth Management, and Callie is becoming concerned, as am I, about the slowing of economic growth and some of the downside surprises we've been seeing in a whole variety of the market data, economic data that all of us follow here at the firm. And I wanted to just get into it and kind of give people a sense of what's really happening, separate some of the noise from the actual signal. Callie, how are things?
Josh, hey, wish I could come on the show on better terms. And I want to be clear, I'm concerned, but it's like a nervous concern. It's not like a doom spiral concern.
Well, yeah, I think, because I obviously read all of your commentary, and I think one of the things that comes through is this doesn't have to mean it's the end or it's a new down cycle, but we also can't ignore it when you've got this confluence of things all sort of, I don't want to say screaming, but all sort of, they're all asserting themselves at the same time. And, clearly it feels like there's been some sort of a turn, but turns can go the other way too. So let's start the conversation with that appropriate caveat.
Yeah, and I think that's good. I think it's right to level set here because there are so many shades of gray when you're talking about, the economic outlook and how you're invested and your time frame and all those things that you're so smart to put out there. So right now we're sitting in a shade of gray, but it's not a black and white discussion. So happy to add the context.
So let's start here. One of the things that none of us wants to see is economic growth slowing, but in the presence of stubbornly high inflation. And I think maybe let's start with inflation first, because the narrative going into this year is that it was time for the Fed to take a victory lap, even though we weren't at 2% per se. If you did X this and X that, you can kind of say we were at 2%. But then there had always been some areas lurking where the inflation was remaining stubbornly high. And now we're starting to see a situation where the economic data is slowing faster than inflation, which of course would be the dreaded stagflation. People are now saying slogflation. But let's start with the inflation piece of the puzzle.
Yeah, so I love that you brought up stagflation because I'm starting to see that again, and that's like a curse word in my mind. You have to be in some dire straits if you're saying stagflation. But where we are with inflation is that the last mile is obviously the hardest. You can see in CPI, PCE, which is what the Fed watches, that inflation is just below or around 3%, which is not the 9% that we saw in 2022, if you're worried about inflation crisis number 2. But it is higher than that 2% target that the Fed is moving for. And the 2% that we saw in the 2010s. I mean, everybody talks about normal and how normal was pre-COVID. I mean, that was normal for us for a decade. So the Fed is trying to get there. It's openly committed to reaching 2% inflation. That's its public target. And Powell has been pretty straight with us. He wants to get there. And the fact that we're stalling around 3% isn't enough for him. But Josh, I'll add one thing. So there's a lot being talked about with inflation right now. And I think you have to sort out speculation from trauma and pain from the data. Because I just told you about the data, but the worries around inflation and the threat around inflation is just, it feels so much greater because we just came out of an inflation crisis and because we have a lot of policy talk around different tariffs and different tax cuts that could ultimately raise inflation.
Well, there's like a recency bias going. There's like a recency thing going on, or an availability bias, where because we've just experienced some of the highest inflation of our lifetime, now anywhere we see even an inkling of it, there's kind of like this reflex where it's like, oh my God, we're going back to 8% inflation. So I understand. I understand that. It's very similar to like stock market attitudes about a correction. Once you've just come out of one, it's impossible not to see the seeds of the next one everywhere you look. So I totally get that. But then the political headlines, like even if you're not paying attention to economic data, all you hear about now is tariffs and what the effect of tougher immigration policies might be. Both of those things are obviously inherently inflationary, and I think that for that reason, people are interpreting the economic data as it comes in as glass half empty, just because it's like, look at the backdrop.
Yeah, definitely. And I'll add egg prices to that. I mean, it sounds so silly, but everywhere you look, it's egg prices are up 20% year over year. I went shopping and there were only like natural farm raised eggs that cost $11 a dozen on the shelf. That
Yeah.
kind of rhetoric, especially in daily life, does inflame those worries around inflation. And look, we are in a period where some prices are rising quickly, but is it this broad-based increase in prices that we saw in 2022, the kind that the Fed needs to choke out? Not necessarily. We're not even close to there, even though it feels that way.
We saw a Gallup poll and a UMich poll, both of which indicating that the bias of just people being surveyed is that they actually think inflation is going up. How much of that do you think is directly related to avian flu, curtailing the supply of eggs, and just the psychological impact of your breakfast being more expensive? Like, is that what's influencing those surveys, do you think, for the most part?
I love that detail for a headline. It makes for a sexy headline. This survey is, and you're right, inflation expectations have jumped in the past month, according to UMich. I don't watch UMich. I actually watch consumer confidence. How nerdy of me. I have preferences in consumer confidence gauges. I watch the conference board, excuse me. But I think it goes back to what we were saying just a minute ago. There is this worry around inflation. And to a certain extent, it is self-fulfilling, Josh. I mean, Powell will say it over and over again. Inflation, the real danger around it is when people start expecting inflation and they start pulling their spending forward, and then you get inflation off the back of that. It's a snowball effect, and we definitely don't want to see that happening. And
this is when people say inflation expectations are, quote, well anchored. They're talking about right. They're talking about like how the expectation itself could turn into a self-fulfilling prophecy if people react based on those expectations.
Right. And you're seeing them in the bond market too. One thing we look at in the fixed income market is this metric called break-even rates. And it's basically the rate that you can earn on a treasury, on a TIPS product, treasury inflation protected securities, versus what you could earn on just a nominal treasury. And the reason why that shows you inflation expectations is because inflation is baked into the principle of TIPS. So if you subtract the two rates, you essentially get expectations around inflation. And those expectations are moving up as well. It's not just a single survey thing, right? UMich can be a little partisan, but we're also seeing that in the fixed income markets. So I think that does add to how worried the Fed is and why they've been a little more cautious about making any kind of move this year. There are just a lot of conflicting signals, and Powell would rather not step on a rake.
So, Callie, you said the stubbornness of inflation and the threat of another price-fueled crisis may not be the biggest risk to the economy right now. Instead of being worried about prices, you should be worried about job loss. And that is what you term a classic growth scare. Tell us why.
Right. So this is what makes this moment so interesting to me. Everybody's worried about inflation, but the weaknesses and the potential weaknesses that are bubbling up are happening in the job market. And of course, if you think about the economy, the job market is so crucial to consider. Consumer spending is 70% of the US economy. People are making money, they're spending money. We're the best in the world at spending money. But when people start losing their income, then you start to have problems. And right now, the job market looks okay, but there are definitely cracks, right? There are a lot of people who are long-term unemployed, not being able to find jobs, especially in specific sectors. You hear a lot about the white-collar recession. Then that's exactly what I'm talking about. A lot of the hiring we've seen has been in government, which we'll talk about, has been in education and health services, these more stable, always on type sectors that are a little less cyclical and serve as a bit of a cushion, but certainly aren't the type of sectors you want to be leading hiring. So I say all that, and the thing that I think really piqued my interest was the layoffs that we saw in the federal government. Just the sheer size of them that people are throwing around could be a warning sign for, the next few months of job market data. And I'm not sure the market can swallow that, especially because expectations are around a good economy and potential runaway inflation. They're kind of on the other side of the boat.
Yeah. So going into this year, there were pretty high expectations for GDP. That's coming off of 2 years where people didn't think much for the prospects of economic growth. Economic growth surprised in both of the past 2 years. This year, the economists on Wall Street didn't want to be fooled again. So they had baked in some pretty decent GDP growth. And that's where the disappointment might happen. And, we spoke with Bob at Unlimited Funds about this concept. And he had this great chart where he just said, like, here's the number one thing you need to know about the markets this year. And it was exactly that. In 23, expectations were low, surprise to the upside. Then 24, once again, expectations weren't so low, but we still surprised the upside. This year, expectations were, I don't want to say crazy high, but higher than the 2 prior years. And all of a sudden now we're staring down the barrel of federal job loss, possibly contractor job loss, government contractors, or I think you told us it's millions of people work at companies that are federal country. Okay. So talk us through the economic data itself slowing. And it's not terribly severe, but we are surprising on a regular basis now to the downside.
We are. So, John, can you throw up the chart on the 10-year yield in the Citi US Economic Surprise Index? That's a mouthful. So if you look at this chart, you can see 2 lines here. You can see the 10-year yield, which is the proxy for economic expectations, that classic rule of thumb that everybody watches in the fixed income market. But the darker line is the Citi US.
We're about 4% and change on the blue line.
Yeah, we're about 4.4 right now, which is actually quite high compared to the last decade. And the darker line you see is basically economic expectations, or how economic data is coming in relative to Wall Street's consensus, relative to what economists expect. And that line moving down shows that our expectations are a little bit high and economic data is slowing, at least relative to what we're expecting. So nothing to worry about. I mean, as you can see in 2020, that line took a nosedive, and for very good reason, but it's not moving in the direction that people are expecting. And I'm not sure it gets much better, at least over the next few months.
So in the summer of 2024, I think was the last growth scare we had. And indeed, so this is indexed to 0. So this is the Citi US Economic Surprise Index. And when it breaks below 0, I guess the right way to explain it to people is this is when the balance of surprises are negative and not positive. So one of the more interesting things that happened last year, we had a kind of a summer swoon and dipped into negative 50 on this scale. And some of the data started surprising to the downside, and people started talking about, here's the growth scare. That's why the Fed has to cut faster. And then all of a sudden, back half of the year, all of the surprises started to come into the upside, and we had a resurgence in the Citi Economic Surprise Index. So now, for the first time since, I guess, last fall, we're hovering around that 0 line again.
Right. And it looks like that resurgence is over. And that's the problem. We had that second wind that came through the US economy, which I think surprised a lot of people, by the way. I, of course, saw the data and I was like, 1 month does not make a trend. 2 months makes a trend, but interest rates are high. And I think we were 4 months into strong hiring, and I didn't throw in the towel, but I was like, okay, I guess we're doing this. But I think, the kind of conditions we're seeing, right, and the slowing that we see in different parts of the economy, I describe it as, pillars of the economy, right? There are risks to every single pillar we're talking about: consumer spending, business spending, housing, government spending, and trade. There are emerging risks for all of those, and that's not a good spot to be in when data is
all
slowing.
At once. Right. So there are multiple versions of job loss pertaining to the Department of Government Efficiency and what Elon Musk is doing. And some of this stuff takes the form of a hiring freeze, where you just have remember, it's 3 million government employees. So at any given time, there are thousands of people retiring. Not filling those positions, it looks more like attrition, but for the purposes of our discussion, it has the feel of job loss, even though it's not per se. Then you have outright job loss in the form of people being offered a buyout. One of our advisors has a client who has accepted that buyout, for example, but just people saying, wait a minute, let me get this straight. I'll get paid till September, and I always wanted to do this other thing, and why wouldn't I just take this opportunity to do it? So there might be a silver lining for some people individually, but for the most part, for people in government, this is kind of like a very scary period of time that they're going through. And there is a sense that, like, if I don't take the buyout, what happens if I get laid off anyway? So I think there have been 70,000 people have accepted the buyout, was the last data I saw. Okay.
Yeah, that's about right. Yeah.
Okay. And then you've got this whole other category. These are probationary employees. So these are people that either they're relatively new to government work and they haven't vested is the wrong term, but they haven't fully become full-time long-term employees. And I think there were 200,000 terminations of those employees. And I'm guessing a lot of people will be hired back for those roles, but they have to be handpicked for some reason by the administration. And so that's why that was necessary. I don't fully understand the logic behind it, but I think what that all adds up to, Callie, is a lot of scary headlines and a lot of confusion. And we haven't seen any of this stuff show up yet and manifest itself in the data, but that's what's about to happen. And we don't fully understand what that will look like when the numbers themselves come out this March.
Right. And that's part of the danger, too. Nobody can really get a handle on how big the layoffs were. I mean, buyouts, I think the number is 75,000. That's reported by the administration. Okay. We could see attrition outside. We have seen attrition outside of the buyouts and layoffs. And the federal government, at least, isn't hiring right now. I mean, there's really no money flowing through it. So put that all together, and I think you have the making of a pretty significant crack in the job market, and we're just not sure to what degree or how big it is. I do have a chart to put some numbers around this because I think scale is important. Perfect. Okay. So the title here, this could be the case if we see all probationary workers laid off and if we see the 75,000 workers bought out. You know, I'm actually going to throw out the buyout workers here. It is still the largest layoff in history if we saw 200,000 probationary workers laid off. But the green line you see here is that 200 or 220,000 layoff around added to that 75,000 roles that possibly took a buyout. But this is a show of scale, Josh. U.S.
So
companies.
It's 300,000 federal government layoffs nominally, and that's a lot. But you're showing us proportionately what that looks like relative to like all private sector hiring, for example. Do I have that right?
Yeah, and where it's coming from, Josh. So I know you can't really see this, but there is a green section on those columns that you're looking at right now. It's at the very bottom and it's barely noticeable. That's because we don't normally see huge federal government layoffs. And add that into the average of 1.7 million in, layoffs or job losses every month for public and private sector companies, and you could have a problem. These are big layoffs. These are big changes to the workforce. And it's not just the layoff part, Josh. It's the influx of people heading back into the job market and trying to find a job in an environment where it's not very easy to find a job.
Potential counterpoint. Isn't that impulse, though, of federal workers now coming into the private sector potentially disinflationary? Because now you've got a larger available pool of workers who can fill roles that companies have had a hard time filling and would be willing to accept the current level of wages versus holding out for a raise.
So yes, in theory.
Or holding out for a higher salary, I should say.
Right. And I think a lot of people are forgetting that. If you're freaking out about runaway inflation, but you're also freaking out about layoffs, there are some trade-offs that may work in your favor here. And I just want to be clear. I don't want anybody losing their jobs. That's not the trade-off that I want. But if you're trying to consider the pros and cons of the economic outlook at the moment, you have to think about that. There's a little bit of balance that's going to happen here. But it's not necessarily a given. Of course, there could be some skill mismatches there. The companies that are hiring might not be, the right fit for the roles that were laid off in the public sector. Another thing I want to think about is the fact that wage growth has been coming down for a while, yet we still see inflation stuck around 3%. And I think that's important. Powell himself will tell you has said every time he's spoken publicly that the job market isn't quite the source of inflationary growth at the moment, which I don't fully believe, but who am I to argue with Jay Powell? But that's something else to consider. You don't automatically see wages cool off if you see that pool grow. In a vacuum, you do, but it's not guaranteed.
You say, in a way, some weakness is comforting. Inflation crises feed on overheated spending and general euphoria. Job cuts could tame prices, albeit in the worst way possible, even though the mood is jubilant in some parts. So you cite CEO confidence. We've seen everyday investor sentiment turn pessimistic over the past month. I guess the silver lining of disappointing economic data and softness in the job market is the Fed becomes less concerned and potentially lowers interest rates, which possibly restarts the upbeat sentiment after all. So it's kind of it's tough. It's if you ask me like what's better, for the overall picture, it's kind of hard. Like I don't know that I would say, oh, I wish all the tariff talk would stop and Elon Musk would stop firing people. I don't necessarily know that that's the best outcome for the investors this year who are focused on higher returns. It's still kind of a tough call, which you would prefer.
Yeah, and I think what you want to see here is a bit of you want to see expectations coming down. I was trying to find a clever way to say it. There's really not a clever way to say it. People need to, set their expectations appropriately, and we're kind of seeing that happen. I mean, at the end of last year, beginning of this year, I would have said that sentiment was jubilant, a little euphoric, probably way too high for where we were in the economy. But John, if you want to throw up the AAII chart, got something interesting to show you. So the AAII investor survey is a survey that happens every single week. It's done among everyday investors, non-Wall Street investors. And this blue line that you're seeing right here is the amount of pessimistic investors, pessimistic over the next 6 months about the stock market versus the number of optimistic investors. And that's coming down. It's come down a lot over the past few months, Josh. And this is just one sentiment indicator.
The bulls have declined precipitously. Right? Do I have that right?
The bulls have shied away. Sentiment has come. It's cooled off a little bit. We're getting back to reality here, and that's a good thing, right? That's a good thing if we're expecting what's a little bit more in line with reality and with the economic conditions we're living in right now, then we're not surprised if something goes wrong. I think this is complicated though. I mean, for every sentiment gauge that's coming down, you have one that's still quite high. CEO confidence, really good example of that. So, going back to the economy and what you would rather have here, of course you don't want job loss, but I think where we're at is a point where we want the Fed to feel like it's confident stepping out and adjusting policy to where we need to go. And I'm just not quite sure we're there. There's a lot flying around and the Fed is being influenced by policy.
Yeah, the Fed has to be above what they would consider to be the neutral rate of rates in order to appear to be tight and to actually be tight, because we've still got this lingering inflation. And it's not as though they've seen job loss fall off a cliff. It's not as though they've seen confidence fall off a cliff. And if they say that they're data dependent, like they almost sort of need to see more of a sign of that in order to tell them to get off of this tight rate and get back down to a neutral rate of interest. So they're above and they know it and they're saying they are. And I think most people would argue with good reason. Some people would say, nope, they're going to be late once again. They're going to start doing bigger rate cuts once the die is cast and it's too late. And they're going to be playing from behind once again. That would be like the criticism of, for example, staying pat the last time there was an FOMC.
Yeah, and it's totally fair. I mean, the Fed has been late many times before. And I don't think people talk about this enough, but when interest rates are high and have been high for years, the economy is extra vulnerable to shocks. Any kind of shock you can think about. Oil prices moving up quickly, a geopolitical shock, a policy shock, which, I'd argue we're already seeing here. So, we can talk numbers all day, but how the economy absorbs those numbers depends on how almost how loose policy is and how confident business owners and consumers feel moving into the future. And that's just not the case right now, which worries me a little bit more.
So you have a description of what a growth scare looks like, but then some encouraging ideas for what you would tell people for us to get through it. But I want to start with the description. You say that investors are not prepared for a growth scare right now. Many are low on idle cash. This includes global portfolio managers. We learned from the Merrill Lynch survey last week. We spoke with Belsky about it, who used to work at Merrill. And you're in this weird situation where everyone's bullish, just gauging the amount of cash that they say they're holding in their portfolios. But everyone also agrees that stocks are overvalued, which you very rarely see those two things be as big of a mismatch as they are right now. But you point to in growth scares, people tend to sell shares indiscriminately. The volatile mix of high expectations and portfolio imbalances could lead to an abrupt shock. But I want to get to kind of what you would tell people is the right posture if we know that this is look, with all of the uncertainty of trade and mass layoffs from the federal government and the economic data surprising to the downside and elevated stock multiples and low amounts of cash across portfolios everywhere, like it really sounds like a nasty combination of conditions. We're still only a few percentage points off the record high for the S&P. I think we made a new record high last Tuesday. So it's not as though we have fully priced in all of those negative factors. But you have a stat going back to 1950 about the sell-offs that could result from this, and I just think people should hear that.
Yeah, so I want to be crystal clear as we wrap up this conversation. I am nervous, not concerned, not freaking out. There are a lot of degrees here. There's nothing in Wall Street world that's black and white. But it is a point where it's smart to think about portfolio balance. Think about taking gains in sectors that have done well. I mean, tech is the obvious one there. Because when you see that indiscriminate selling, if we were to get a bad headline around the job market, around policy, then it probably hit tech and growth stocks the hardest. Historically, that's what we've seen, right?
Live by the gun, die by the gun.
Live by the gun, die by the gun. Yep.
If you're concentrated in like the 20 or 30 stocks that have the biggest gains on the year, you are definitely going to feel the brunt of the growth scare much harder than the typical investor would.
Yeah, you're on the roller coaster for better or worse. So That's okay. You can hold a little bit of that. You can take risks, but just understand that, as market environments change, you need to be really agile with your positions. I mean, the other thing is, of course, there are long-term treasuries. Treasuries are the classic economic hedge. Classic economic hedge when the economy turns south. The one thing I think you have to be careful of here is that there's a lot of policy expectations priced into the 10-year treasury, for example. So maybe think a little bit shorter there if you want something that'll hedge you against, true economic turmoil, true economic weakness. But I think that's kind of a nuanced opinion. As long as you're holding some kind of treasuries, or you feel comfortable with the cash and fixed income you're holding, then you're probably fine. The other thing is, it's a great time, as it is any time, to set a crash plan. The stat that you were talking about, the S&P hits some bumps. You hit setbacks when you're taking risk. And the S&P has declined 5% or more 91 times since 1950. So that puts you at about once every 10 months. So once every 10 months
or more, we've had 91 instances of a 5% sell-off from the high.
Correct. Yeah.
Okay.
And those 5% sell-offs, they sound small when I'm talking about them, but they don't feel small when they happen.
No, because they happen and they're accompanied by news. So of course, they not only do they not feel small, they also don't feel like they're an end in and of themselves and they're finished.
Yeah, and they never feel like how they seem on paper. But this is empowering. It's good that you know this because you can prepare for it. You can understand that many of these sell-offs are quick storms. I think less than a third of them, or about a third of them, last less than a month. And you can basically prepare for them. You can put out a crash plan and say, if stocks decline 5%, if my portfolio declines 5%, then maybe I stay put. If my portfolio declines 10%, I'm still not worried, but maybe it's time to deploy some cash. If my portfolio falls 20%, then maybe we take a little bit more extreme action. Probably not selling completely out, but
Yeah.
maybe converting to a Roth, for example, or tax loss harvesting, for example. So
Now,
you
of
have a
course,
lot of
if you're
agency here.
100% stocks, you have no agency, and your only crash plan is I will panic. If
It's
right,
sell. That's your agency.
that's your plan because it's your only plan left. If you
Hmm.
have a diversified portfolio, the negative is in 2024 you had to listen to all your friends talk about how much money they were making in in software stocks and cybersecurity stock. But if you went into this year in a diversified portfolio, first of all, good news, probably made an all-time high in valuation as recently as last week. And second of all, if this growth scare turns into something more, you will have options. And that is, I think, in a time like this, is the only time that you really appreciate that. And I think people will.
Yeah, you hit the nail on the head there. Give yourself options and don't make friends with people who brag about stocks and nothing else.
Callie, you are the very best. Let's tell people where they can go to subscribe and get your regular notes. Your optimistic Callie, which is all one word. It's optimist, ICALLIE.com.
Uh-huh.
Optimistic Callie is your regular letter. And if anyone's paying any attention to the financial media, you are literally everywhere. Fox, CNBC, Bloomberg, Yahoo Finance. You do such a great job. Thank you so much for joining us today.
Yeah, thanks for having me. I mean, this is my favorite place to come to, so I'm honored.
All right. We'll talk to you soon, Callie.